It's been hanging around like a bad smell for a while now, but with the federal election done and dusted, it has come back into the spotlight. And of course, we are talking about the new tax on superannuation balances above $3 million. Now, this new tax is called Division 296 tax. And if you're familiar with Division 293 already, well, even the name's probably instilling a little bit of fear in you. So today we are going to go through exactly what this new tax is, why it's got people all riled up, and we're going to look at a few strategies that are floating around out there in order to be able to help you along the way. So let's jump straight in. Now, there's a bit of confusion out there, so let's clear it up. This is not a full 15% tax on your superannuation fund. It's not even a full 15% tax on your full amount of earnings. What it is it's a 15% tax on the earnings that are generated from balances above the $3 million threshold. So for example, let's say that your superannuation balance is $4 million. Well, the threshold is 3 million, you've got 4 million, so you're $1 million above that threshold. Now let's say that your superannuation fund has earnings of 200,000. Well, you are 25% over that threshold, so 25% of the earnings, which is $50,000, is going to be subject to the new Division 296 tax. So 15% on $50,000, you're looking at a $7,500 bill. But here's the real weird part. The government is calculating your earnings based on the increase in your total super balance. So that could be from interest, it could be from dividends, it could be from rent, but it could also be from capital growth. So your capital growth is going to be counted even if you haven't sold anything. Which means for the first time ever, the government is looking at taxing unrealized capital gains. And that has got a lot of people up in arms. Say you've got a self-managed super fund and that self-managed super fund owns a commercial property and that commercial property goes up in value by $500,000. Well, the government wants you under Division 296 tax to pay tax on that $500,000 gain, even though you haven't sold the property. So the big question is, when you've got an illiquid asset and a tax bill, well, how do you fund the tax bill? Another really big controversy around this one is that under the current structure of the legislation, the $3 million cap limit isn't indexed. So while it only affects around 80,000 Australians, that's about 0.5% of the population, moving forward, if it isn't indexed, it is going to impact significantly more and more people every single year. It's not unlikely that a 35-year-old who earns $100,000, puts a good amount of contributions into their superannuation, has some decent investment returns, well, they are going to be impacted by this new tax. Because $3 million by today's standards is a lot of money, but we all know how compounding and inflation and everything works. So $3 million in 30 years time, isn't nearly as much. So the tax on unrealized gains and the no indexation are the really big controversies around this new tax. But there's also a few other things to consider. The double taxation risk. So let's say your super fund has already paid the discounted 10% tax on realized gains. Now, if your total super balance also grows, the ATO might tax you again on the same dollars. There's no credit given for the tax already paid. It's like being taxed twice for the same thing. This tax might accidentally open the door to dodgy asset valuations within self-managed super funds. So if you're running an SMSF and you have private assets, there's now a bigger temptation to undervalue them to dodge the threshold. Now, of course, the ATO is aware of this, and let's be honest, they're watching. And of course, it opens the door to further reform. Now, the Greens, they already want the cap limit reduced to $2 million. And who's to say the government won't start taxing unrealized gains in other areas? So yeah, this thing has legs, and there are a few potential landmines out there that we need to watch out for. Now, if you're in the firing line, so your superannuation balance is $3 million or more now, or it's likely to be $3 million or more, well then let's consider some of the strategies that are floating around there at the moment. And like with most things when it comes to superannuation, it's best to plan early. A number of these strategies that we're about to look at involve taking money out of your superannuation, and in order to do that, you need to meet a condition of release. So I will link in the description box below a link to our strategy library which talks about some of the common conditions. The first strategy would be to do absolutely nothing, because if you think about it, if you add an extra 15% tax on superannuation, accumulation phase is already 15%, so that's a 30% tax rate. Now, if you are looking at your personal marginal tax rates, that could be as high as 47%. So it can still potentially be quite tax effective to leave funds in superannuation despite this new Division 296 tax. The only time this might be a really big problem is if you are heavily concentrated in your superannuation with growth assets, where you don't have a lot of liquidity. Then the question comes, how do you fund this extra tax? The second strategy would be to rejig the structure of your assets. So this is where you would look to take money out of superannuation and put it in another vehicle. So you'd be looking at your personal names, maybe a family trust, maybe a company, or things like investment bonds. Now, I think actually the investment bond providers out there are pretty excited about this new tax because it's gonna mean that investment bonds have a bigger place in retiree portfolios. You could also potentially look to shift between member balances within superannuation. So if one person has a really high balance and is gonna be impacted by this tax, but your spouse doesn't have so much in superannuation, well, there's strategies that you can use to equalize the balances, providing of course you can have access to withdraw and recontribute the money. If you plan nice and early, you can also potentially look at a spouse contribution splitting arrangement. Now, just be very careful when you're moving assets around because you really don't want to be triggering unnecessary capital gains and things like stamp duty. So if you're not sure of what you're doing, make sure you get some proper advice. The third strategy is gifting. And this is where a lot of the younger generations are thinking, yep, bring on the tax because it might mean I get an early inheritance. So in order to reduce your amount of assessable assets, obviously you are free to give away the money that you have. But just remember that once you give it away, it's gone. So unless you actually want to give a gift or an early inheritance, well then there's no point in doing it just to avoid tax. And the final strategy is to do proper valuations on the assets that you hold in a self-managed super fund prior to 1 July 2025. Now, this new Division 296 tax is supposed to kick in from 1 July 2025. So that means that they're gonna look at your total super balance effective as at the 30th of June 2025 as the first point of reference when calculating the gain in superannuation. So if your fund owns unlisted assets that are currently undervalued, well, you need to make sure that they are fairly valued prior to the 30th of June 2025. Because if you don't, and you value them later once Division 296 tax has kicked in, well, there's gonna be that big jump in gains that's gonna potentially be taxable under this new tax regime. So that's it, Division 296 tax in a nutshell. Yes, it's a bit of annoyance. Yes, there's a few quirks to it, but no, it's not the end of the world. I think the biggest issue here for me is that this is another rule imposed on superannuation that is hard for the average person to understand. And if someone doesn't understand something, they're not gonna trust it. And so on one hand, the government's encouraging us to put more money into our superannuation, increasing employer contributions and all those good things. But then on the other hand, they reduce the ability to understand superannuation, and people just see it as this ever-changing box that they don't want to put a lot of trust or money in because things could change rapidly. So for me, that's the biggest downside, because otherwise superannuation is a fantastic system that if you're not using properly, you're probably leaving some money on the table. But if you found this video helpful, please give it a thumbs up and I will see you guys in the next one.